food inflation is staring at us.
Between Fed or food, I think we need to first focus on food.
We are definitely looking at food, but also following Fed.
Instead of Fed or food, which my co-panelists have spoken about, let me add a word called friction.
Definitely food itself within our entire inflation basket is what really dominates the household's own perception of inflation.
First, we have to understand that monetary policy is a cyclical tool and not a structural tool.
This moment, food prices are high and putting pressure on the overall CPI.
Hello and welcome to the show. We will have a chat with 5 economists. Fed or food? Ridhima was saying a lot of complicated things, but let me put it very simply. What we want to understand is this is local versus global. That's what, and it's what do we expect from monetary policies and all. Should we walk the path following Federal Reserve, not only Federal Reserve, Bank of England and others, what's happening and all, we need to respond. I'm not getting into all the technicalities, the difference between Fed rates and our rates, and the 10-year yield in India and US. Of course, this is a very critical for money flow, both outflow and inflow. But we want to hear from you. I don't want to talk about that. So what do you say? Have we actually decoupled ourselves, or no, we continue to follow? Our governor, Sachchidanand Das, has been continuously saying that, well, Fed is cutting the rate, but how does this matter to us? Our priorities are different. Our realities are different. Our priorities are different. There is an echo you can't hear, right? I mean, he is also, Sachin also saying, CA also saying the same thing. So, yeah, I don't know. So, a governor has clearly said that we are decoupled. That's what he said. Maybe decoupled is my word, but probably he also used it. So we don't need to follow the Fed's footsteps. But there are people in your community believe that no, I mean, we can put up a show that we are decoupled, but actually we cannot. We need to follow sometimes. Now, why, when, how, or is there any merit in the talk, or no, we are actually decoupled and we go by what our ground reality says, like food inflation is staring at us, which is a thing Governor again had said day before yesterday that the October number would be far higher than September. So where is the question of any rate cut, even though Fed has cut the rate? That's putting it very bluntly. So we'll hear from you. We'll start with one of the two between Aditi. We'll go by alphabetically. So Aditi, you said. First, some preliminary remarks, then we'll get into all the things.
Sure. Thank you so much for inviting me back for this panel. I'm going to keep it short. Between Fed or food, I think we need to first focus on food. If we take your other parlance, local versus global, then I think local is paramount. Many times you've heard the RBI governor say as well that our domestic growth inflation dynamics are going to supersede what's happening globally. 2 points from my side. One, if we look at our households and how inflationary expectations are created, definitely food itself within our entire inflation basket is what really dominates the household's own perception of inflation. It's the stuff that they buy every week and the stuff they pay every month. In my view, food and rent are the two defining factors of inflationary expectations, and these are inherently driven by local factors. So that's a vote for food and for local. The other thing that I just want to say to kick off is that if we look at our own forecasts for growth and inflation and how much rate cuts can be supported by the medium term or the next 12 to 18 months, we think that only 50 basis points of rate cuts appear feasible in the Indian context. Whereas from the Fed, the amount of rate cuts will be far sharper than that. So in any case, it's not like we're going to be able to do a matching. We're not going to be able to do a one-to-one. So the timing of the rate cuts, therefore, should be very much more centered on what is appropriate given our own local context, rather than upfronting it and front-loading it to line it up with the Fed, and then having a long time after that where the Fed continues to cut, but we're at the end of our ammunition per se.
Dr. Soumya Kanti Ghosh.
Thank you, BS, for inviting me back to this, and it has been always wonderful to speak at this event. The topic is very interesting, fed or food. If I want to sum up in one word, I think we are definitely looking at food, but also following fed in a different sense. So the first thing is to note is that I think if I want to make an assessment of the current scenario, there has been a lot of geopolitical uncertainty in the last few years. If I take 20 as a starting point when the pandemic started, then there was the war. It has continued. Recently, there has been an election in the US. There has been a lot of noise regarding the elections. But if I take all these factors together, I think there are a couple of things which is clearly discernible from the data if we look into it a little more profusely. The first thing is that contrary to the popular perception is that trade or interest rate or inflation could be a casualty in case and relating it to the US election results doesn't seems to hold ground if you look into the historical data. If you just look into the example from 2016 onwards till 2014 on the dollar rates, the US interest rates, and also on the other trade movements, you will actually find that this, apart from a brief period of disruptions, the trends are actually continued to favor. For example, if you look into the value of the rupee, it has been largely in consonance with the domestic fundamentals. So has been the interest rate. In this point, I would like to recollect that India had we faced the worst pandemic with the lowest borrowing cost. So I think most of these numbers are now, I think, agnostic to the global developments. I'll not say agnostic, but mostly immune to most of the global developments because they have evolved over a time. So that's my first point. So I don't see too much of a disruptions to the Indian macro in terms of global disruptions. If there is some impact on the global economy, that could obviously impact, but that's not going to be too much. Coming to the inflation part, I think there has been a lot of rising, but I think food inflation has always remained an enigma in the Indian context. And it will continue to remain an enigma given the fact that climate disturbances are now a huge part of our day-to-day life. You will see that the last couple of years has seen that the unseasonal rains, other things taking center stage, temperatures taking center stage. So in my sense, I think it will continue, the food inflation will continue to be an important factor. The only way you can to look into this, you can have a debate on whether, what could be the trend in it, but I think that you can't ignore that part of the food inflation component. And finally, if I sum up in terms of the rate decisions, I think it's best left to the discretion of the central bank. But past experience suggests from 2008 onwards that whenever central banks increase rates, that's always a coordinated action, and whenever they cut rates, that's specific to the country. So that has been the example of 2008 after that. So if I take that factor into account, I think Indian rate cuts will be specific to India and not to Fed as such.
Thanks so much. It's pretty interesting. I was not aware of this, what you said, that the rate rise happens in sync, but rate cut country specific, and for you it's not Fed food. Right, Sachchidanand, you represent a little different sector because they are all bank economists, these two gentlemen. You are with another entity from corporate India, you see. Just tell us Fed or food.
Let me add one word to this, and
Please.
this is not a play on the alphabet F. Let me say, instead of Fed or food, which my co-panelists have spoken about, let me add a word called friction. Friction in terms of trade policies. And if you look at what the US has done, it has championed a concoction of industrial policy, which is very muscular, combined it with trade policy, energy policy, energy security, and geopolitics. And if you add the dollar, which is the reserve currency of the world, to this concoction becomes explosive. And markets, policymakers should be cognizant of rate of change. Something has really changed with the US elections, and this has to be a part of the reaction function of central banks around the world. I don't think that the RBI can really ignore it. Yes, food is important, has been important. Within the CPI basket, I mean, we've just seen the CA speak about the relative importance of food, etc., in monetary policy. But the point I'm making is simply this, that the underlying has changed, and some of this must go into the reaction function of even the RBI.
So it's Fed, not food, in other words. So 2:1, Samiran. And you will have a casting vote if it's 2-all. Ila, I'm talking about you later. I said you will have a casting vote if it's 2-all. MPC has 6, like if it's 3-all, then governor has a casting vote. So anyway, yeah, Samiran.
Good afternoon, everyone, and thanks for inviting me here. So I'm going to couch this more in your language of global versus local rather than Fed versus food, and I will tell you why. I guess first we have to understand that monetary policy is a cyclical tool and not a structural tool. So the point that Sachchidanand was mentioning, in my view, that has to be addressed by different policy instruments. We can also be very muscular with our industrial policy, but I don't think industrial policy can be challenged by monetary policy. Having said that, if you believe in this cyclical part, then what we need to understand is that globally, what are the cyclical factors which are common for most of the countries? So something like commodity prices affects almost all the countries similarly, and to that extent, the monetary policy response also could be similar. Or, for example, Anand was mentioning about the trade routes and sways and cost of transportation. That also could be a factor which is common across the board. So when central banks are responding to those common factors, you could see some commonality in the policy actions as well. But I think the bigger challenge is that what we are observing in another context is, and connecting to what Shomola was saying, is that emerging markets typically have an asymmetric policy response. When the Fed is hiking, they need to hike because of worries of currency depreciation. But when Fed is cutting, there is no immediate need for a cut because currency appreciation is, in an odd way, a good problem to have. So what we are witnessing today, the reason why there is divergence in central bank action vis-a-vis Fed is that dollar is not appreciated very significantly, which would cause any damage for EM. So I think these are the
that was till recently. Now we don't know.
I mean, this is not a monetary policy. That's a fiscal, trade, industrial policy issue which is driving dollar today.
Yeah.
So this is, to me, the two important directions, the commonality of the cycle and this particular factor. But why I avoided the Fed versus food thing is that within local, there's a big debate on how much emphasis central banks should put on inflation versus growth, and within inflation, how much emphasis should be put on headline versus core. That, I think, is a very different debate, so I've covered the debate in my way.
We'll get that, yeah. Ila, we'll discuss that. Yeah.
Thanks, Tamal. Let me begin by thanking Business Standard for inviting me here. Early in my career, I was a columnist for the Business Standard for 5 years, and I see familiar faces and friends here, so it's a delight to be here. what determines monetary policy, and in particular RBI's monetary policy, are three things. The first, of course, is inflation. We've been debating about whether food should be part of that basket or not. One of the reasons why food was chosen to be part of the basket when RBI was given the mandate of targeting inflation, and it was given the mandate of targeting the headline inflation, was because that's what consumers relate to. And when it was studied at the time, it was found that almost every one of the 30 countries that had moved to inflation targeting was looking at CPI. So I think, as Anand correctly pointed out, it is a question to debate. We have debated it. Earlier, when the mandate to the RBI was being given, and for many, many years, RBI's position used to be keep it out. And exactly for the reasons that Anand mentioned, which is that it is not something that RBI has direct control over. So maybe the non-food part, and that's what some of the research on monetary policy showed, that it is the non-food part where the impact goes, and that's how the overall comes down. And that is an issue that will continue to be debated. And we know that at this moment, food prices are high and putting pressure on the overall CPI. The second thing is RBI's mandate of being mindful of growth. And I think here earlier we heard this very interesting question that Tamal you asked, and then which is that the RBI governor seems to be saying 7.2, and you are saying Ministry of Finance is more between 6.5 to 7, which is a little lower than 7. I think it's very, very interesting that RBI should be viewing this at this time and looking at the signals of mixed growth. So, I mean, I think everybody in this room who follows high-frequency indicators would agree that the signals are mixed. You're seeing some indicators showing an improvement and some showing a decline, and we're all trying to make up our minds and take
improvement is GST, both manufacturing and service sector PMI, vehicle sales, petrol, diesel consumption, international passengers arrival. These are the positives. That's what they were talking about.
Yeah.
Please carry on.
So, the fact that the governor sees the economy as doing well, which in other words, as Samiran pointed out, monetary policy is a counter-cyclical tool. So you look at where you are on the business cycle and not growth as something in isolation. And there, okay.
Yeah.
There the governor is indicating that he's seeing the economy as on the high part of the cycle. So that's the first one is inflation, which is food. The second is the growth situation. And the third is the Fed, which let me call it the INR USD. And we know that RBI has had looks at the INR USD, tries to keep volatility down, avoid sharp fluctuations in the INR USD. And this is something that, you know, old Mandal Fleming models all tell us that you cannot have an independent monetary policy in a situation where you target the exchange rate and have an open capital account. So what does it mean for the INR USD if the Fed starts cutting rates now? If the RBI were to cut rates now. And I think that would increase the pressure to depreciate on the INR, which, as Soumya Kanti pointed out, is not a nice problem to have. I mean, he said, you're saying, guys, are saying the opposite thing, which is that an appreciation pressure is a nice thing, but a depreciation pressure is not that nice a thing. If you start defending the rupee, you start losing reserves. After a point, you get panicky. So even that indicates keep rates higher. So it's food and growth and Fed, and all of them are at the moment indicating that
we have to wait.
We need to wait.
Yeah, because if we cut the rate, then for the investors, US market becomes more lucrative than India, and the outflow which already started, we have been seeing FII, will intensify.
So that is one reason. At the same time, if food inflation is high and if the growth is also good, then why cut? So at least that's the scenario now. Just before I finish, I'll just want to mention how does Trump's Trump's victory impact what we think about what RBI may do, may not do. If, as many people are speculating, tariffs come in, tariffs on China, whether it's 60% or it's 10% on everybody, we don't know what exactly will come in, but if there are higher tariffs in the US, if there is inflationary pressure in the US, and if there is expansionary fiscal policy through tax cuts that he's been suggesting, he's been indicating, then that really means that the Fed may slow down on its rate cuts.
Cutting cycle,
on its cutting rates. So we may actually see a longer period of cautiously wait, see, and go ahead on that.
Till recently, the dot plot was suggesting many more cuts, but Trump returning to power, you think it will be delayed, right?
It will be delayed.
Will not be as aggressive as, because the fiscal situation will be different.
Fiscal as well as inflation, both may be different.
So you spoke about the core inflation versus food inflation. Just the number is this: in CPI, inflation in August was 3.65. September went up to 5.5, 5.49 actually. September is anybody's guess. It could be even beyond 6% or 5.9 or just about 6. Food inflation, which was 9.24 in September, actually went up to 5.6 in August. And vegetable prices up 36% in September versus 10.71% in August. Tomato, onion, and potato, top, people call them, they are all the spoilers and all. And core inflation continues to be pretty benign. So, Samiran, you started the debate, and our CA just left. So do you see, which part of that on this debate that let get out of food, RBI does not need to bother about food inflation when it comes to monetary policy, because at the end of the day, central bank does not have anything to do with food, and interest rate can't contain food inflation.
So I would say that it's a very complicated debate, but let me just put my fingers on two things where. And for the moment, I'm arguing in favor of the RBI view. I know that we can all switch our hats and start arguing Anand's view as well, because there's merit in his argument as well. So one aspect is that to what extent the food inflation can get transmitted through inflation expectations and wage behavior into actual core inflation as well. Indian data seems to suggest an asymmetric behavior here. So our analysis shows that this food inflation getting passed on to core inflation, higher wages, happens more through urban wages, but does not happen through rural wages. In rural wages, it's the opposite. When rural wages go up, rural inflation goes up. But when rural inflation goes up, rural wages do not always go up. So in an odd sense, if you do not look at this headline inflation, you will affect the income inequality also, because rural wages will not go up, meaning the rural-urban wage gap will worsen even further. Also, what's happened is that despite core inflation staying low, if you look at the cumulative inflation post-COVID, that's 30–40% for most of the commodities. And cumulative income growth has not been as high. So there has been a persistent decline in purchasing power, which one could point out as one of the reasons why consumption growth has been relatively weak. So for one to have this purchasing power back, we need an extended period where income growth exceeds inflation. And for that inflation, headline inflation, it doesn't matter whether it is coming from X item or Y item, headline inflation needs to be much below wage growth for a sustained period, which is where I have sympathy with RBI's view.
View.
And the second point is very simple. That's just saying it's much easier to communicate policy in terms of headline inflation than in terms of core inflation. We all have our own preferred core indices. Which one would RBI prefer? It will become nightmarish. Some people even prefer to exclude gold prices from inflation. Should we even go to that point? So, or should we just stick to only vegetable prices? So it's a complicated thing to communicate monetary policy with respect to core. And the absolute last thing, what Anant also mentioned, if it ain't broke, why fix it? This is working well for almost every country that I know of, except for, to some extent, Japan and Thailand. I think every other country just follows headline inflation. Why should we move to a core inflation matrix?
Thanks,
That's
Samiran.
what my argument is.
We have a very literate audience, but core inflation is just, if anybody is not aware of this, it's non-food, non-oil. That's the core inflation. Sachchidanand?
So the very first thing I want to say is some clarification in terms of what Samiran pointed out.
Please.
When I said friction, what it does is it will lead to some bit of devaluation or depreciating pressures on especially the countries that are not really in sync with the US, which is the Chinese neighbor.
Which
and-
Ila also hinted at.
Exactly.
Yeah.
So
Ila
I think
hinted at.
I just wanted to clear that misunderstanding because it will have implications for monetary policy. The last time around, the yuan fell 5% when Trump came in, and when he started announcing another 1.5% depreciation. And all the neighbors, so we don't really compete with the Chinese directly in many aspects, but what it does is that competitive devaluation will have to be part of the RBI's reaction function. So your rate cuts may get delayed, your currency depreciates and things like that. So that is just one part. I think the more important thing in this whole debate is why should you cut rates? Once you answer that, and you have your arguments for that, it's much clearer by how much and when and all of that. If you look at the growth part, just taking RBI numbers, for the second half, their numbers Q3, Q4 are 7.4. The potential growth rate that they've calculated, and many people have, is 7%, right? So if there is no output gap, and you yourself are saying 7.5 and that sort of a number, so yes, there is some loss of momentum when you look at some of these high frequency indicators, but at best, it is mixed any given point in time, right? But looking at the projections, there is no growth scare. Is growth tanking? No. Then we come to the inflation argument.
Yeah, Sachchidanand, we'll talk about the rate cut in another round, given a choice, and we'll take a few questions after this thing. So right now we are talking about what the CEA floated the idea that let's not discuss the food. RBI should only focus on core inflation because RBI has no control over food inflation. Interest rates have nothing to do with food. On that, where are you with the side with CEA or the other side?
I think that's very much settled, at least within the economist community that I know.
Yeah. What is
very
that?
much settled, which is you should not really tinker around with that. You have 8 years of evidence of the Monetary Policy Committee. It's done a fair bit in terms of containing volatility. What it does is gives you, irons out volatility in terms of your exchange rate, inflation differential, interest rate differential, and so much more certainty on growth. So in terms of the objectives and achievements, yes, there was this COVID period. I would say it's done a good job. Let's persist with it for time being.
Ila?
I've been part of not just the debate on this for the last 15 years, long before we did this. And I've always had this view that we should include food, and being part of the debates when the ministry and the RBI were deciding this. I just want to add from that.
Please, go ahead.
One of the points that was discussed was that the reason to have core is because that is what demand conditions is what RBI can impact through the interest rate channel, and therefore they said core. And by the way, core also, various exercises were done. One was to make it non-food or non-oil. One was to cut out the most volatile, the top 5% most volatile, and so on. Many exercises were done. Now, while that was true, I think Samiran pointed this out very clearly, that the reason to go with food, even though there is an acceptance that the RBI cannot impact seasonal onion prices, but the one big reason to go with food, included food, which is that headline CPI, was because that is the only measure that has legitimacy with the public. So when Parliament is going in, and when MPs are saying we are passing a law saying that we, as the state, which includes government and RBI, will bring inflation down, are giving a mandate for inflation down. If you say that to households who are saying, "Daam badh rahe hain,"
Correct. Yes.
you have no legitimacy.
Yes.
So it is that which was the most important and deciding factor, and till today remains the most important and deciding.
And barring a few exceptions, that's the global trend.
Absolutely. In that we saw Thailand go to core and then go back to CPI, and at least we studied 30 countries and everybody was
Yes.
doing headline.
Aditi?
I'm very much at headline for the same reasons. And as you also said, there are parts of core which are very volatile and sensitive to what's happening globally. So if we start stripping off lots of stuff, we'll probably end up with a very small component left where we feel that the RBI has a greater amount of control. And again, I completely agree with the argument that for a household, the two biggest expenses that are going to drive their thinking every week and every month in terms of how they feel about their incomes, how they feel about their prosperity, is going to be food prices. And to my mind, the second most important thing is rent, particularly in the urban areas. And going back to something that Samiran was saying, this is anecdotal, I don't have any data for it, but where we find that food inflation transfers most quickly into the rest of the inflation basket in urban areas probably is through rents and lower end rents. And that's where the whole sentiment channel gets affected very quickly as well. So headline for me, at best, maybe just taking vegetables out, because vegetables have taken on a volatility that is really quite difficult to predict as well in the Indian context. So headline, or at best headline X vegetables.
Okay, thanks, Soumya. And after Soumya speaks, anybody wants to ask any question from the audience, just get the microphone ready. Soumya, over to you.
I also share the same opinion, but I have just two different points I'll make. I also take on Ila's point a little bit, which she mentioned in terms of the demand. The first thing is that if you look into the data of, say, headline CPI, core CPI, and food CPI over the last, say, 4 years or 5 years, you will find that the mean, the standard deviation measures, if you look into them, you will find that the standard deviation of core CPI and that of the headline CPI are nicely aligned, while that of the food CPI is significantly higher. So this clearly shows that the core CPI actually, has the inflationary expectations argument which the others gave, that has been nicely contained by the RBI in terms of ensuring that both both stay lower, and that impacts the headline inflation. So in my part, I think headline inflation should be always targeted in terms of if you're doing inflation targeting. But one small point which I want to mention, I think, and we have been saying this for repeatedly, is that, and I think the government is already doing it, looking into the CPI measure more holistically now. The point which Ila made, that in terms of the core inflation, which is a more mere indicator, is a more profuse indicator of demand, is correct. But if I make a comparison with countries like in UK, whereby the interest sensitive part, like for example EMI payments, are a part of the these countries like UK, is absent in a country like India. So sometimes it's difficult to measure what is the extent of demand So I think over a point of time, there has to be an appreciation of these small methodological issues. But in my sense, I agree with the fact that headline is a better option than targeting core, simply because of the fact that food CPI, it's always important that food CPI doesn't get generalized into the core CPI through the channels we have mentioned.
Thanks. Yeah. Anybody from audience? Yeah. Can this lady get the microphone, please? Anybody from other side, just raise your hand so that you can get the microphone fast.
Hello.
Yeah. After that.
Hi, my name is Deepthi Jetwani.
Can you talk a bit louder?
Yes. The entire conversation today was if we should remove vegetables and grains from the CPI that is monitored by RBI. Now, even though the RBI doesn't have a direct control on commodity prices, the government and the RBI work together. As per Maslow's hierarchy of needs, it's roti, kapda, or makan. Both of these institutions need to work together to monitor these prices. If the RBI moves to remove, no longer monitoring the price of food, would we be removing the checks and balances from the system, giving RBI more freedom with the way they move with interest rates, and that would in turn harm the economy? Sorry for the long question, but that's all. Thanks.
I could not exactly follow what she said, but Ila, I think you understood, so please you answer.
No, so
Can this gentleman get the microphone? Yeah, please.
I want to respond by saying that there is a reason why central banks were given the mandate of targeting inflation. And that is that it is not at every point of time, the government, especially an elected government, can target inflation. There are many times when actually the government either wants to do fiscal expansion or in some cases give higher MRPs to farmers, higher prices for procurement to farmers because of a particular state election, and so forth. So the reason why, if you look at the monetary policy literature, which, so going back the last 30 years, you'll find that it was political cycles which actually led to this, that it led to the understanding that, look, government cannot always target inflation, and therefore create an institute, give that mandate to the central bank to target inflation. And in some ways, that's kind of what is playing out, that yes, while the government does want lower prices and more welfare and so on, but sometimes, whether it is fiscal expansion or whether it is specific food procurement prices, where the government has its own reasons not to be, where it is unable to fulfill the role of targeting inflation. And that's why it's given to the central bank, which is given this instrument.
Thanks, Ila. Yeah, this gentleman, please.
Yeah. Good afternoon to the panel. My name is Neville. I have a question to the panel that with Trump returning to office, he is expected to influence the Fed's policy. He is supposed to be more interfering kind. So will it change the policy of the Fed, as Trump is expected to be pro-growth, low interest, and it will increase inflationary risk in the future in a way that is also expected that Fed may go less aggressive on interest rate cut. Will it in any way change RBI's rate cut policy, delay possibly?
Samiran, your bank is US bank, so you better answer this.
Look, I don't know whether you got a chance to see midnight Jerome Powell's press conference. So this question was asked to him, and he gave a very curt response in that, saying that if Trump wants him to resign, he will not resign, because that much independence that Fed has got. So I don't think that as such the government there can put pressure on Fed to do certain things, But the second part of your question is what the Fed will have to deal with, which is its own response function to Trump's policies. So if hypothetically Trump is raising tariffs and those tariffs turn out to be more inflationary for US, then Fed does not have a choice but to respond to it. As I was saying that if this happens, then this will be a common inflationary trend across the world. So most central bankers in other countries will probably not have a choice but to respond. And this is also connected to the fact that these tariffs are likely to make dollar also stronger. So if dollar gets stronger, if other countries don't hike, then their currencies will get weaker, the point that Sachchidanand was mentioning. So that beggar thy neighbor policy in some sense, everyone doing the same thing, that can continue to some extent. RBI could also be caught in it. But I think the main issue to track would be that are we going to enter a slow inflation period going back to the period of great moderation of 40 years of 2% inflation, or are we, because of many reasons, tariff is one of them, there are many other reasons, because of which our natural inflation rate is, let's say, 100 basis points higher than what it used to be. That in itself will determine what the terminal rate of interest for Fed is going to be. That will determine how much rest of the countries will also respond.
When you was talking about you meant US, right? The 2%. That's the US target 2%. Yeah. I think it came down to 2.1 now, right? Last was 2.1. I'm just thinking.
Right now it's low, but
yeah.
What the Trump tariff will do to it, that's what we are predicting.
So we have exhausted our time, but just one sentence each probably this time, though. It's all of us, you said that it's not Fed, it's food. That's primarily most of you, but there are other implications also. So starting from Sachchidanand and all, so when do you expect, you are the economist, you have you know better than anybody else, when do we expect Reserve Bank of India to bite the bullet? Last policy, they changed the stance, and then subsequently RBI governor has been talking about changing the stance doesn't mean anything, that we are rushing to rate cut. He was talking about inflation rising, so on and so forth. But just tell us, when do you expect the cut, and in this cycle, where would the rate stand ultimately? Just one sentence each.
I would say first quarter of next calendar year.
That's February.
By then,
that's February.
Yeah. And okay.
And sorry, and where do you see the rate?
I think it is going to be very, very shallow. Like I said, there are multiple things that have changed. Being cognizant of that, it could be very, very shallow, 25 to 50 in the entire cycle.
So at best, it can go down to 6% from 6.5, first rate cut in February.
Yes.
My answer depends on if the Fed cuts. If the Fed cuts, then yes, I agree. If the Fed stops cutting and indicates it's not going to cut because of the policies,
then it will be further delayed.
It will be further delayed.
Fed next meeting is mid-December after the RBI policy.
Or when it comes to February or April or whenever the policy.
Okay. Aditi?
Feb 2025 or later.
Feb cut 25 basis point.
The earliest rate cut could be in February of 2025 or later, and at max 50 basis points.
Soumya?
Before I answer, just one. Look at Fed,
Please.
follow food. So this is the mantra now. And in my sense, I think...
Look at Fed, follow food. Okay.
Yes.
Okay.
So that's...
Look at Fed, follow food.
So in my sense, I think the rate cut cycle could be a little delayed. I'm not seeing it in 24, 25 maybe by April or February, at most 25 basis points. So overall 50.
Not too different. I think Aditi phrased it well, February or later. That max 50 basis points. But our US guys, for what it's worth, they think that the December rate cut could more likely to be 50 basis point by Fed. And that will continue next year as well.
Okay, so that's the end of it. And I would pick up what Soumya said, that it's not Fed versus food. It's look at Fed and follow food. Right? All of you agree with that? No. Thank you, Ila. Ila does not agree. So give them a big hand. We have come to the end of it. Thank you. Thank you all.